All right, 5 o'clock on the dot. Seems like we got quite a few people on here, but we are going to go get started and see if anybody else joins us in a minute. My name is Chris Ingram. I looked at the participants on here. Quite a few of you know who I am. For those of you that don't, my name is Chris Ingram. I'm the CEO and founder of Prosperitas Financial. I'm also a financial advisor. Have been a financial advisor for the past 25 years. And I'm also the head of our investment committee here at Prosperitas Financial and the head portfolio manager for our portfolios. And today, we've got a lot to cover. We had a webinar at the end of the first quarter, and it went very long. And I promised at the end of that webinar that we would not let this one go that long. So I'm going to jump right into it and get us going so that we can get you guys out of here as soon as possible. Well, first of all, I want to thank all of you for joining us. We have some great information to share, and so I appreciate you taking the time out of your day to come listen. We want to discuss a couple of key things today, and we have 3 speakers this evening. I am going to be the first speaker, and I'm going to go into a little bit about what occurred since the beginning of quarter 2 with regards to the markets. Then we're going to bring on Michael Sherbert. Michael Sherbert is managing director with Milburn Ridgefield Corporation. They are one of the fund managers in our portfolio. So he's going to tell you a little bit about that fund and why we use it in our portfolio based on some of the things that I'm going to talk about. And then we are going to wrap up the evening with Peter Shuper. Peter Shuper just joined Prosperitas Financial within the last month or so. Peter has been a financial advisor for over 22 years, and he is an options trading specialist. So he'll tell you a little bit about options, what he brings to the table, and why we're so excited to have him as part of the team. So let's get going with my portion, which is what occurred in the markets since the beginning of the second quarter. And if you weren't paying attention, it was a brutal second quarter for the markets. First quarter was rough. Second quarter was even worse. As you can see from this chart, this is the second quarter. That pink line is the Dow Jones, down over, 10%. S&P 500 was down over 16%. The NASDAQ, the purple line, was down over 21% during that time period. Put that together, year to date, at the end of the second quarter, we had the Dow Jones down over 14%. The S&P 500 was in bear market territory, which is down more than 20%. And the NASDAQ was certainly in bear market territory, down close to 29% by the time we ended that second quarter. So what was causing that? A lot of it was information that we'd received regarding inflation. Inflation was showing signs of being stickier than we originally thought, more persistent, and that it was going to be more difficult for the Fed to fight inflation than the Fed originally thought. The Fed continued to raise interest rates. They had a 50 basis point hike in May, another 75 basis point hike in June. And the news started to talk about fears of a recession, things that could potentially push us that direction. And what was that going to look like for the markets and our economy? As you'll see on this chart, right around June 16th, the market hit this low point. And since then, it has been a very different story. This is since June 16th. The market has had a rip-roaring rally back the other direction, and it doesn't seem to be slowing down at the moment. We'll see how that plays out. But if you look at this chart, you have the NASDAQ, which is up over 20% just since June 16th. You have the S&P 500 up over 16% during that same time period, and the Dow Jones up over 11% over that time period. So where does that put us year to date? Year to date, Dow Jones is down 8%. The S&P at this point is only down 10%. And you have the NASDAQ down 18% for the year. So quite a bit off of those lows that we saw off of June 16th. So what drove that rally the other direction, I think, is what's on a lot of people's minds. And can it continue? So let's look at some of the information that we received since the end of the second quarter. So First bullet point is that consumer price index, inflation for the consumer, was at 9.1% for June, which was higher than was expected. We had producer price index that came in at 7.3 in June, which was also higher than expected. We got a Fed raising interest rates another 75 basis points in July to try and fight that inflation. We had second quarter GDP that came out showing a negative 0.9% GDP for the second quarter, which we were down 1.6% in the first quarter. That put 2 consecutive negative quarters in a row for GDP, which according to most definitions would tell you that we are already in a recession. You're saying to yourself, all of that news sounds terrible. That sounds everything we were worried about in the second quarter, which was driving the market lower, all of it seemed like it was still very, very negative, and yet the market was rallying. And so I will say that throughout my history, one of my favorite lines that I hear from clients time and time again is, how is the market going up when there's so much bad news? And it happens quite often. And some of that may be some of the silver linings that you can see. So let's go over some of those silver linings that we got from the data during that same time period. The first one was non-farm payrolls of 372,000, which is very, very good. We had unemployment data that came out showing that we had unemployment at 3.6%. Which is historically very low, as you can see from the chart right here. We had industrial production that was down 0.2%, which was showing signs of slowing, but not all that bad. We had retail sales that were up 1% for June when they were down 0.1% for the month of May. So retail sales actually looked very, very strong in June. Some would argue, oh, that just means that the consumer is putting money on their credit cards. Not necessarily the case. These 3 charts that you see right here, the first one shows that while there was some credit card being piled up during that time period, a lot of consumers had stacked up excess savings during the previous couple of years, and they were spending some of that rainy day emergency fund to help fund some of that spending. You also show over here, this chart shows the percentage of debt payment as a percentage of household income. So what that's showing is how much are the payments that they have to pay on their debt versus the income that they're bringing in. As you can see, that also is very low. And we looked at delinquency rates, and while they did have an uptick towards the end of the quarter, they are not all that bad compared to history. So retail sales being up 1%, while some would fear that that just means the consumer is putting a lot on credit cards, didn't seem all that bad, but it did show strong signs that the consumer was still very much willing to spend. Throw on top of that, a lot of people thought, well, that means that the consumer is tapping into the equity lines in their homes, which I said in my last webinar that a lot of consumers did pull money out of their homes and they were spending that money. But when we look at the mortgage market, only 3% of mortgages right now have negative equity, which means that most consumers aren't going to walk away from their mortgage anytime soon. And 99% of mortgages out there are a fixed rate, and a pretty darn good fixed rate at that. So the consumer, the silver lining there is the consumer still looks fairly healthy in the face of inflation and all the things that are going on with the economy. The other silver lining, or the takeaway that might have come during that time period, was that the Fed may have hinted at the fact that they were getting towards the tail end of their rate hikes. And all of that makes a lot of sense. If you actually go back to the beginning of the year, the Fed told us that they were going to raise rates somewhere in the ballpark of 9 to 11 times. And they were talking about 25 basis point or quarter basis point hikes. If you listen to them about a month later, they said, we're going to front load those. We're going to do a lot of those hikes early versus stretching them out over time. And if you look at the hikes we've received from the Fed up to this point, the Fed has raised 9 quarter-point rate hikes. So they are getting to the tail end of that 9 to 11 rate hike range that they were looking for. And they are probably getting fairly close to the end of their rate hike trend that they were going on, and probably are getting fairly close to putting the brakes on that and seeing how it goes. We did see CPI or inflation numbers come down a bit in July. It was not any significant drop. They were still 8.5%, so very high, but a little bit less than we saw from the previous month. So some would believe maybe inflation has peaked and it's starting to come down a little bit, but obviously it is still very high. And some of the information we received regarding global supply chain looked like they improved a little bit. We saw ocean freight rates that had dropped down a little bit. We saw trucking capacity had gone up, and we saw inventories start to stack up. As you can see in this chart, we had a big drop off in inventories going into 2020, some of that due to supply chain issues. And as you can see, a lot of that has improved recently, and inventories are starting to get back to a normal level. Lastly, but not least, we had relatively good earnings from corporate America over this last earnings season, showing that corporate America, while they are concerned, are still doing relatively well. So the question is, the news still seems very, very soft. While there are some silver linings, is that enough to give the market a big rally or the strength that it needs to continue this rally that we've seen in July going into the new year? And the answer is nobody knows. It's tough to say. There's a lot of conflicting data out there. There's still definitely some weakness. There are some silver linings, as I mentioned. But all in all, it looks a little rocky, and it's tough to say for sure. And more importantly, it's impossible to know in the short term where things are going to go. Markets often rally when news is still negative because the markets are typically looking at the future, and the markets may be seeing things improving over time, and that the recession might not be as bad as we think. It may be relatively mild. The markets may be looking to the future saying, hey, we're going to come out of this thing relatively soft, and that things may be okay. So the market is looking out, not looking at the present, and thinking that things look a little better than they did previously. And that's what has started the rally. But can it continue? So the problem with that question, and I mentioned this in my last webinar, was that's an impossible question to answer. It really is tough to say where the market's going to go in the short term. And I often get upset with people that try to pretend that they can predict the short term. So here's a couple of examples of what's going on right now. Here's a gentleman from Bank of America, a quote that he said recently saying, "This is a painful rally for many. We say fade the S&P 500 above 4,200 and go short the S&P 500 above 4,342. Now, this rally is probably painful for many, including this gentleman at Bank of America, because he probably missed and was out of the market going into this rally in July, and it caught him off guard. And now he's hoping, if he tells you this, everybody will fade the market at 4,200 and go short at 4,342, so that hopefully they drive the market back down, and he doesn't end up losing his job. So sounds like he's trying to cover his you-know-what at this point. If you look at some of the other information out there, Ned Davis from Ned Davis Research, he had a conflicting statement recently. He said, I think investors should get more aggressive. We see a soft landing. The market is going up from here. Citigroup recently came out and said something similar. We like the market going forward. We think we're going to avoid a recession and people should get back into the market. And then you have gentlemen like Michael Burry, who's famous for his big short during the 2008 crash. He came out over the last couple of days and has been nothing but negative, saying he's selling all of his stocks, getting out of the market, and he thinks a huge crash is still to come. So who do you believe? Problem is, you can't believe any of them because none of them know what they're talking about. All of them are just guessing. And we don't like guessing. One of the big main philosophies we have here at Prosperitas Financial as a portfolio management team is we don't try to make big gambles with our clients' money based on a future prediction that we can't make. And so we think more long-term. We like to stay invested. We make adjustments and tweaks to our portfolio based on what we think the market is throwing at us, but we don't do anything that is overly risky or trying to bet or make big bets, because we don't want to get our clients into trouble and we don't want to get ourselves into trouble. If you haven't been paying attention this year, you may have seen a lot of other companies have made very large bets this year, as we've seen several hedge funds and mutual fund managers that have closed their doors or lost their jobs because they have made very large bets trying to predict the future. And again, it's a very difficult thing to do. So we don't do that here. We stay balanced, we stay in the markets, and we make tweaks and adjustments. I often say a lot here as the portfolio manager, we want to hit base hits. We don't want to hit home runs. Hitting home runs, you run the risk of striking out and causing problems. We just want to stay in the game, nice solid base hits, and keep things moving forward for our clients and keep things more predictable and a little bit more stable. So what I'm going to go into a little bit today is something that I typically don't talk about, but I think it's important for clients to understand. And I'm going to get into the weeds of portfolio management and what we do as a portfolio management team to try and help with portfolio management long-term and staying in the game and hitting those base hits that I'm talking about. So this is stuff nobody ever really wanted to know, right? It's the details of what we do as a portfolio management team, but it is very important to what we do as a portfolio management team. And it's the risk parameters we put on a portfolio to understand how it stacks up in any given market environment. And it's also tools that we use to be able to look at our portfolios and determine how they're doing and if adjustments should be made based on the current market environment. So I'm going to go into some of these specifics real quick for you and give you a kind of a lesson on risk metrics within a portfolio. So the first one, and they're all on the screen here, is what's called alpha. Alpha is how we look at a portfolio to determine how much is our portfolio capable of capturing the upside of the market when the market is going up, and how likely are we to outperform or exceed what our benchmark is going to do during that time period. And so 0 means that you're in line with your benchmark. Anything above 0 shows that you have the opportunity to outperform that benchmark in a good market environment. And so what you're looking at here is one of our portfolios. It's actually our conservative growth portfolio. And as you can see, our alpha over a 3-year period is 3.06, over the 5-year period is 2.9, and over the 10 years 2.8. So all that tells you right off the bat is we have a very high likelihood or opportunity to outperform our benchmark over an extended time period and what has occurred over the past. So we have the ability to capture when the market goes up. Right below that is beta. Beta is the opposite side of that. It tests our portfolio for volatility and systemic risk when a market is in trouble or having difficulty. So a 1 rating on beta means we are completely in line with our benchmark and the markets, okay? Anything below 1 shows that we are taking on less volatility and less systemic risk than our benchmark itself. And so again, as you can see, we have a 0.8 for the 3-year, 0.8 for the 5-year, and basically a 0.8 for the 10-year. So we are currently positioned to have less volatility and less overall risk than our benchmark. R squared is another kind of correlation to our benchmark, and it's as a percentage. So 100% would mean we are completely correlated to our benchmark, and our ability to capture the returns of our benchmark over time are very high at 100%. What you can see here is that we have a 95% for the 3-year, 95% for the 5-year, and then 95% for the 3-year. So right off the bat, what this is showing you just in those first 3 is that we have a very high alpha or ability to outperform our benchmark. Our R squared at 95% means we're very likely to participate in or have correlation with our benchmark as far as performance is concerned. But our beta is showing that we're doing it in a less volatile fashion by taking on less risk in our portfolio than the benchmark itself. Another one to look at is this number over here. It's called standard deviation. Standard deviation, similar to beta, is a volatility parameter. So it's how far does our portfolio spread from the mean, and how much volatility, upside and downside, does our portfolio get in different market environments. And so what you'll see here is that our portfolio has 12 over the 3-year, and our benchmark is showing 15. Over the 5-year, we're showing 11.6, and our benchmark is showing 13.4. 10-year, the portfolio is showing 9, and the benchmark is just shy of 11. So similar to our beta number, our standard deviation number is showing we have less volatility, or we're taking on less volatility or overall risk from the mean compared to our benchmark. So again, high potential to outperform, high correlation to the benchmark as far as obtaining the returns we want in good market environments, and beta and standard deviation showing less overall volatility and less risk to the portfolio in volatile times and under different market environments. And then the last one, which is probably the most complicated to explain, is the Sharpe ratio. The Sharpe ratio removes risk-free assets from your portfolio, such as treasuries or cash or anything like that, and looks at how is your ability to capture returns compared to your standard deviation or your volatility in the portfolio as an overall assessment of your portfolio's ability to, on a risk-adjusted basis, perform in different market environments. And so a higher number is better. So you'll again see over the 3-year, we have a 0.57 versus 0.33 for our benchmark, 0.65 over the 5-year versus 0.4, 0.95 versus 0.68 over the 10-year. So again, our ability to capture returns on a risk-adjusted basis improved or is better than our overall benchmark. So what I'm first showing you is a brief lesson on what some of these pieces of data mean and how they're crucial to when we build a portfolio, trying to determine, do we have what we really want, which is the ability to achieve maximum return while reducing risk as much as possible for that given portfolio, which is what every client wants and every investor wants. Upside potential we want to capture, but we want to limit our risk and downside. And that's what we're looking at with the way that we design this portfolio and the way these data points are telling us. But more importantly, is when you get in different market environments like what we're in right now, you can look to these indicators to help you determine how you should be adjusting your portfolio given the market environment. So let's take what we're going through right now. When you have risk like we have right now and volatility and things are a little bit more scary and uncertain, while we don't leave the market, like I said, we're not the type of portfolio manager like a Michael Burry that's going to jump all in and all out and put your guys' money at risk by trying to time the market or answer the impossible question of what the short term or what the future looks like. We make those adjustments to the portfolio to better weather whatever storm is being thrown at us. So in a market environment that is difficult, we will actually try to reduce our beta and reduce our standard deviation to pull some of the risk out of the portfolio. And as we do that, we can look at our alpha and our R squared and some of these other numbers to see how much are we going to take away from our upside potential and our return potential based on getting more conservative. And We can also, in good market environments, we can increase our beta or increase our standard deviation to capture more alpha or have more upside potential. So we can constantly play with these numbers and make tweaks and adjustments to the underlying investments within the portfolio to pull back on risk at times and still be able to capture upside potential, or increase risk at times and try and capture as much as possible on upside potential. But it allows us to test the portfolio under different circumstances where we can actually make fictitious adjustments to the portfolio, add different investments to the portfolio, and then look at these numbers and see how did it affect our portfolio from a risk perspective and from an upside or overall opportunity of capturing upside in the market potential. And so these become very important to us and something that clients don't care about on the most part. And we rarely talk about because it's complicated and it's confusing and most don't understand it. But I thought it was important under these circumstances to give you guys a little bit of an understanding of what goes on behind the scenes of portfolio management to try to better position the portfolio for success in the long term and how we adjust the portfolios over time, given the different market environments that are being thrown at us. So we've done a lot of that this year. When the markets are good, you can kind of ride it out and just kind of sit. But when markets are difficult and volatile like they are right now, we've been playing with these numbers and adjusting the portfolios quite a bit to try to position ourselves for success, regardless of what the market throws at us. So we were not out of the market when the market rallied in July into August, because we had made tweaks and adjustments to the portfolio, but we didn't go all in and all out like some would, and we didn't put your portfolios and your money at risk by doing so. So now that I've kind of explained that, it is a segue also to our first speaker that we have here tonight, because I will bring him on. Michael Sherbert is the managing director for Milburn Ridgefield Corporation, and they run one of the mutual funds within our portfolio called the Catalyst Milburn Hedge Strategy Fund. And it's an important fund to what I was just talking about because it is what we call an alternative strategy. So it has very low correlation and it brings down some of those numbers that I was just talking about. So adding funds like the hedge strategy to our portfolio has allowed us to play with those data points a little bit and improve the portfolio given the market environment that we're currently in. So I would love to bring Michael on and have him tell you a little bit more about himself and his company, and then I'll ask him a couple of questions about the portfolio itself and how it is helping us do some of the things that I just talked about. So Michael, thank you so much for joining us. Really appreciate you coming on. And I think best way to start is if you just give us a little background on yourself and the company and, the fund itself.
Yeah, great. Thank you. And thanks everybody for the opportunity to visit with you. By way of just a brief background on myself, it's really the product and the investment discipline that's really the star of the show here. So myself, I've been with Milburn now a little over 19 years. And in those 19 years, I've held various roles and responsibilities within the firm. But academically, my background, I have a master's degree from Emory University with an emphasis in statistics. And so everything that we do is model centric, meaning that we use models, mathematical models, algorithmic models to help drive the buy and sell decisions across the entire portfolio. As was mentioned before, and I really appreciate that, which is to say that the markets have a life of their own. They're very difficult. And anybody that can tell you that they can predict with any certainty or clairvoyance, I would run away as fast as possible, because these markets really just have their own, they've got their own drivers, and sometimes those drivers change. But fundamentally, we do believe that the markets are very forward-looking and they care about things that matter. And so Milburn as a firm has been trading money in the alternative investment space. We utilize types of instruments called futures contracts, and we use those to buy, and it allows us to get access to markets all around the world. And Milburn as a firm started back in the 1970s. And the portfolio that we're talking about today actually started in 1997. So it does have a fairly long track record, especially within the alternative investment world, which managers, as also was mentioned, they can come and go. But Milburn has tended to be a fairly consistent performer of driving results. And those results that we drive are fairly unique, I would say. And first is, and again, so Milburn itself has been around for since the 70s. By way of just a couple data points that I think are fairly interesting, the firm itself manages about $8 billion in assets under management. And approximately half of those assets are in this specific strategy, the Catalyst Milburn Hedge Strategy Fund. Of the nearly $8 billion, a little over $8 billion that Milburn manages, just under $500 million is proprietary capital, meaning that's our money. We invest right alongside anybody else that invests with us. We have no competitive advantage. We have no break on any of the fees. We are right alongside all of our investors. So in the good times, we certainly smile and we celebrate alongside. And when there are some difficult environments, we feel the pain directly with everybody. And as we do know, markets tend to go up and they go down in price, as we've seen so far this year. And to that point, I would say that markets tend to go higher than people anticipate. They go lower than anybody ever desires. And this uncertainty tends to go on for longer than anyone really has an idea. One of my favorite quotes from John Maynard Keynes was, or is, markets can remain irrational longer than you can remain solvent. And so we utilize systematic approaches like algorithms, if you will, mathematical models that help drive these buy and sell decisions. And also, as was mentioned, we're not trying to hit home runs either. We're trying to hit singles and doubles. And we do that by investing in a world of about 100 different futures markets, whether they range from interest rate, which just means government issued bonds, currencies, the US dollar versus foreign currencies, stock indices, both domestic in the United States as well as foreign, and then commodities. And those commodities that we trade would be broken down into three subcategories. The first is energy. The second are metals. And so we invest in both precious metals as well as base or industrial metals. We trade those metals both in the United States as well as in the London Metals Exchange, or the LME. And then lastly, we trade in agricultural commodities, softs, as well as grains and some livestock. So I know that there's been a lot of movies that talk about commodity trading and what have you. We're just trying to use those mathematical models to help give us an edge to generate returns as consistently as we possibly can. And as was mentioned, Milburn's been managing this strategy with this discipline since January of 1997. And so consistency is certainly one of the hallmarks that we try and achieve. Certainly not positive performance every given month, but when you look at a longer broad-based period of time, we tend to drive consistently, we tend to drive positive rates of return. We have lost money in 3 calendar years since 1997, but those may not be the years that you're thinking of most readily, like a 2008. Specifically in 2008, we actually made money. But we did lose money in 2011, where we were down 7%. And a lot of that loss was as a result of the U.S. credit getting downgraded and a lot of uncertainty in the bond market. We did lose money in 2018. There was a lot of uncertainty going into the fourth quarter there, where the S&P did finish down 4. We finished down 2. By the way, in 2011, we finished down 7. And then in 2020, with the pandemic, we did finish down 0.49%, roughly 0.5%. So from the standpoint of driving consistent returns, we do try and drive consistent returns. All of those risk metrics that Chris was talking about are metrics that we eat, drink, sleep, breathe. Those are risk metrics that we look at and evaluate, and the models drive. And so Chris, and then I'll turn it back to you just as a broad-based introduction of myself and the firm as a whole.
Yeah, no, I appreciate that. Highlight a couple of little areas for us. My clients tend to hear me talk about alternatives quite a bit. I'm not afraid to tell my clients to, invest in things that aren't even necessarily in my scope or things that I control. My clients have probably heard me talk about rare whiskey being, incredibly, profitable over the last 5 years or so, up some 500%. So they don't get confused. Could you highlight a little bit about why you guys and what asset classes, you mentioned the futures, what makes them alternative and what makes them non-correlated to the markets themselves?
That's a great question. So when you talk in terms of alternative, I guess it really begs the question, alternative to what? And so in our case, when we talk in terms of alternatives, we are an alternative to your traditional stock and bond portfolio. Okay, well, what does that mean? Well, we trade in things that are beyond the scope of just stocks and bonds. And when you talk about a stock manager, typically the stock manager will invest in individual companies or individual stocks. We as a firm invest in stock indices. So when you look at a stock index, we would only trade, for example, the entire S&P 500. Or the Dow Jones, or the NASDAQ, or overseas, we would trade in the German stock market, like the DAX, or the Spanish stock market, the IBEX, or in Brazil, the Bovespa. In Asia, we would trade in the Japanese markets, in Osaka, in the Nikkei. And so that's the first aspect of alternative is we do trade in different things other than just the traditional stock and bond portfolio, although there are, as mentioned, stock indices, and there also are bonds or interest rates. The only bonds that we trade are government issued bonds. So if you think about the U.S. trades a lot of different bonds, whether it's a short duration or a 2-year or a 5-year or a 10-year. And so we do trade along that entire continuum of time as well. But we also trade in foreign bonds, like, as I mentioned, Germany. Germany issues debt in the form of bunds and baubles. A bund is a 10-year equivalent to the U.S. 10-year, but from Germany. Japan trades in Japanese government bonds. Most foreign governments around the world do issue debt to continue to operate. And we trade those debt instruments. So again, I go back to alternative to what? So we do trade stock indices, not individual stocks. We do trade bonds, government issued bonds, not traditional corporates or municipalities or anything along those lines. But we also trade in other things like currencies. Now, the value of currencies, when you think about currencies, like a company like Porsche, for example, Porsche drives most of their sales outside of Germany. In fact, most of their sales happen in North America. Well, when they sell those cars in North America, specifically the United States, and they want to repatriate that currency back to Germany, there's a currency differential there, or there's an exchange rate differential. And perhaps some of you went to Europe this summer and saw that the US dollar versus the euro almost achieved parity for the first time. The euro and the dollar were almost at 1 for 1, which was the first time since the mid to late 90s when the euro started. And so we do trade those types of, and so I guess what I would say is there's a great deal of depth and viability to these markets, currencies, for example. But we also trade in commodities, which are very difficult to trade. So the first area of alternative to what is we trade in about 100 different markets, both domestic and international. The second thing that we do that makes us alternative is we trade in a long and short fashion. Long meaning that we take positions where we buy positions where we anticipate price appreciation or prices going up. In other words, we would buy low and sell high, which I'm sure many of you are familiar with that phrase. But selling short, and it sounds like Chris has done a phenomenal job of educating all of the clients, and so I don't want to belabor this, but selling short just means that if prices are anticipated to go down, you would want to be able to make money as that price goes down. So first and foremost, diversification is one of the massive keys for us. And second, the ability to go both long and short. That's what makes us alternative. And that's what drives our return stream in any given year. sometimes those returns are going to come from, in the last few years, obviously stock indices were a wonderful place to generate return. This year, we've made money being short stocks, but we've made most of our money being long energy, where we've seen great runs in the energy market space. As I'm sure in California, you've seen the gas prices at the pump go up pretty significantly. Well, you can take a little bit of pride in knowing that one of your money managers actually made money on that price appreciation, as that was one of the markets that we've been able to trade. So diversification is a real key for us, of market, but also long short.
Excellent. Yeah, I appreciate that. I will point out, and you can correct me if I'm wrong, one of the things that non-correlation, or being quote unquote alternative, brings to the table, and you mentioned this, is your ability to perform in different markets well. So you know, saying that you had a positive return in 2008 while the rest of the markets were getting crushed. And also, I think a lot of people think, hey, if these guys make money when the market goes down, well, they probably don't perform well when the market goes up. And your guys' ability to perform in a good market environment is just as good as your ability to perform in a down market environment, which brings a lot of stability to the table and adds to that non-correlation. So again, correct me if I'm wrong here, but I did pull some data points just to have for the call. It looks like right now we're showing you guys are up 2.5% year to date. It looks like you guys are up around 10% over the last 12 months. And one thing that I think people should know is that in your category, you guys are amongst the top 2% of funds in that category, of all the funds that are in that category. So you guys are not just good, you're good amongst your peers. You guys have a very good track record for a very long time now.
I mean, obviously, I appreciate that. That's kind to say. We just kind of keep our head down and keep driving. We try and drive returns and drive performance as best we can. But yeah, you're right. Historically, we've done our best work when markets have had some headwinds. As you mentioned, this year we're up about 2.5, which anything on the positive side of the ledger at this point in the year is we would consider a victory.
For sure. Yeah. Thank you very much, Michael. I really appreciate you taking the time, and I also really appreciate you guys doing such a great job with the portfolio. Our clients, thank you. You've added a lot of value. And again, just for the clients listening, we didn't just add this portfolio recently. We've owned this fund for quite some time now in the portfolios. We did increase our exposure to them recently based on what the market was throwing at us. Going back to what I was talking about before, is making adjustments and tweaks to our portfolio. We increased their allocation within our models, but we have had this fund in our models for quite some time now, and we've been very, very happy. So again, Michael, I really appreciate the time, and I appreciate the way the fund has been run.
Thank you.
All right. In the interest of time, we are 15 minutes away from that 1 hour marker. And I want to hand it over to our next speaker, which is none other than Peter Shuper. Peter Shuper is a financial advisor. He was previously with LPL Financial. Honestly, we brought Peter over to Prosperitas Financial because of his good looks and his incredible personality. He just happens to be really good at trading options on top of it. But no, in all seriousness, we fell in love with Peter as a person. And then we really loved the concept that of the 30 portfolios that we run here at Prosperitas Financial, none of them have a direct options trading strategy attached to them. And so not only did we get Peter's incredible personality around the office, we also brought in something that we didn't previously have access to. And we brought somebody who has a very long track record of doing it and is very good at what he does. So it opens up the door for our clients and the people listening to have another strategy available. If you're my client listening, and I know some of you are, you'll know that you probably own 2 or 3 of our portfolios. We mix and match based on, putting different solutions together. Peter just brings another solution to the table that I think is viable to add to that mix for some clients. we are very lucky to have him. So what I've asked Peter to do today is to give you guys a kind of a lesson on the basics of options trading. I don't know how much you guys know about options and if you guys have ever been involved in them in the past, but I'm asking Peter to kind of give you a brief education on what they are and how they work, and then talk a little bit about his philosophy and how he uses them in his portfolio. So Peter, thank you so much. I'm going to hand it over to you and let you begin. And like I said, let's start with, how do you use options? What are options? And, how do they work fundamentally?
Thanks, Chris. Thanks for inviting me. I have to say I am not as well versed in technology as I am in options. So let me see if I can get this to share properly.
Do you want me to pull it up, Peter? I can pull it up for you.
Would you mind doing that for me? That'd be great.
Yeah, you are good. Let's go.
While you're doing that, I'll just give you a brief history. I actually cut my teeth with options at a firm called Kroll Weeden. They're no longer Kroll Weeden. They were bought out by, I think, R.A. Davidson. They were the largest independent broker this side of the Mississippi. And I learned a lot about options from some old school brokers that had been doing it since the early 70s. And I've just been utilizing it in my portfolio ever since. So if I click, there we go. Thank you very much. So as you can see here, understanding the basics, a long option is one that you buy, a short option is one that you sell. One that you buy gives the buyer the right to buy or sell the underlying security at a specific price and a specific date. On the opposite side, if you sell an option, you may be obligated to buy or sell depending on the specific date and price. One of the things that I like to utilize in my portfolios is covered call writing. We'll be talking about that today. There are a lot of different types of strategies, but the sort of the simplest or the rudimentary one that we'll talk about today is covered call writing. And if you go to, I can go to the next screen, right? All right, so here is, if you go to the screen with the Chevy on it, that'd be great, Chris. So I'm actually a Ford guy. I don't know why I picked Chevy. I figured,
we can't work together anymore. We're a Chevy family over here.
Sorry about that. But I do love Chevys. But let's say I want to buy this 57 Chevy that we see here. And I find one online for sale for $5,000. And I don't have the money, or maybe I do have the money, but I don't want to buy it yet. I want to do a little bit more research. So I talk to the owner and I ask him if he'll go into, an option contract with me, and I'll pay him, let's say $100, to give me time to research the car a little bit more for the next 3 months. So on a specific day, 3 months from now, I'll either decide to buy the car or I won't. And so as I'm doing the research, I find that this car has the original turbo fire V8 engine. The owner thought it was just an inline six. So now the car is worth maybe a little bit more than $5,000, perhaps it's worth 10. I have the right to buy it. I'm not obligated, but I have the right to buy it for $5,000, and the owner's obligated to sell it to me for $5,000. And now I can turn around and sell it, let's say, for $10,000 for a $4,900 profit. $5,000 minus the $100 that I paid him, $4,900. Pretty simple. But on the opposite side of the coin, let's say I discover that it's really only got a 4-cylinder engine. It's been in a lot of crashes. Every panel has Bondo in it instead of steel, and the car is really not worth the $5,000. I can just walk away from it, just like you would a lease. I walk away from the contract, and all I've lost is $100, right? So that's sort of the underlying principle of covered call writing, and it's sort of the underlying principle of understanding what options can do at their base. So if we go to the next slide, which is trading considerations, you can see here under leverage, it says you can control a large investment with a relatively small amount of money. Well, what did I just do? I controlled a potentially large investment, $5,000 or the car, for a small amount of money, right? And that's what you can do with options on the one side. And on the other side, you can just use that money as income for yourself, depending on the positions that you have. So options give you the flexibility of allowing you to speculate, but it also gives you the ability to hedge your bets in a downward or slightly downward market. And if you have existing positions in a stock, you can use your options to lock in unrealized gains, to mitigate losses, or to utilize less capital on your investment, on your initial purchase. We'll talk about that on another day. That's a more complex and more sophisticated option strategy. But for today, we're just going to go over the very simplest ones, which are covered calls. All right, so covered call, excuse me, is a neutral to bullish strategy that involves selling calls, collecting a premium, which is cash in your account, and rolling the options out if necessary. They can be used to generate income and offset a portion of the downside. So on the one hand, you can just take an income if the market's flat, and if the market is slightly down, it mitigates that loss by the amount of money that you bring in. So a few terms that you might want to know are at the money, out of the money, in the money. At the money means that the strike price that you choose is right where the underlying security is price-wise. So if a stock is, let's say XYZ is trading at 100 and you choose a strike price of 100, you're at the money. If XYZ is trading at 100 and you choose 110 as your strike price, you're out of the money by $10. And if you choose a strike price of, let's say, 90 and XYZ is trading at 100, you're in the money by $10. Naturally, at the money generates more money, premium coming in, and notice the word premium because it is used as insurance. At the money calls will get you more money than out of the money calls. In the money calls will get you more money than both out of the money and at the money, because for every dollar that you're in the money, you're going to get at least that much plus whatever time value there is left in the option contract. The further out you go, the more time value there is. And so there's really three factors that price your option for you. It's the length of the contract, whether it's a week out, a couple of days out, a month out, a couple of months out, a year out, 2 years out. The more time you have, the more time value there is, the more premium you collect. There's also the intrinsic value. The intrinsic value is how close to the strike price the underlying stock or position is versus the strike price you choose. So again, if you choose a $100 strike price and there's a $90 underlying position, you're going to get less money than if you choose that same $100 strike price and your underlying position is $100. Okay. And then finally, and this might be the most important one, it's the implied volatility. How volatile is the position that we're actually selling a call in? If we're talking about something like a Procter & Gamble or a Kimberly-Clark or any one of the core blue chips that has a lower beta, a lower sort of volatility, historically is less volatile than other stocks, you're going to get less premium. But if you go with a Shopify or an Amazon or a Meta, these stocks tend to move a little bit more sharply. You're going to get more premium. With that premium comes a little bit more risk, obviously. So let's move on to the next slide here. Let's say you own 100 shares of XYZ Corp. It's trading around $32. You can pick whatever strike price you like for each month or each week, depending on the underlying stocks. Some of them have weeklies, some of them have only monthlies. We take a look at your portfolio and determine what would be the best for your particular interests. So now we're going to take a look at an over or out of the money call. So that means the strike price is higher than the current price trading on the stock. And if the call is assigned, which means you're going to get called away from the stock, you're going to have to relinquish your position at the strike price that you set. Now, there are ways out of that if you sort of get seller's remorse or change your mind and you don't want to hold on to it, or perhaps you think maybe there's a little bit more run to go on the stock. There's always a way to roll out of your existing contract, roll into a new one, and still bring in a credit into the account and not have your stock get taken away. The more aggressive stance you take, the more money you take in. A lot of my clients in particular, they like to utilize this strategy inside of their IRAs, but they do that with stocks that they're not married to. And what I mean by that is, let's say you've inherited an IRA from a loved one, and some of the positions may mean something to you. You might, it might be the first stock that your grandfather ever talked to you about. You don't want to lose that stock. I would highly recommend not writing a covered call on that, simply because you always run the risk of having that stock getting called away from you. taken away from you. If you're not married to your stock, then you can, go in and out of a stock inside of an IRA without any tax consequences or implications, and really get aggressive and bring in additional cash. So you could buy a stock for $100 and write a call a week out for 105 and bring in $1. So that might not sound like a lot, but you bring in $100 on that stock, and if it goes to 105, you get rid of it at 105. So now you've made 600 instead of 500, and then the following week you can get right back into it and do it all over again. I have many clients that do that. It's a lot of work, which is why you hire me to take care of that, because you do have to keep an eye on these things. All right, so what are some of the potential outcomes? We talked about a couple of them. Scenario one, your stock is at or above the strike price. If that were to happen, you're going to get called away. If in scenario two, the stock is below the strike price, your option is going to expire worthless. And typically when I do this for my clients, unless they've got an aggressive stance, that's what we want. We want the option to expire worthless. And I know that might sound wrong. It might sound like, well, wait a minute, I don't want something worthless in my portfolio. Well, it's an option contract that's worthless. In other words, when we first sold it, it was worth something, and we got money for that something. By the time we get to the expiration date, if it's worthless, that means that we've captured the entire premium that we received on that initial sell date. There are times when the strike price, not the strike price, I'm sorry, when the option becomes more expensive than what we sold it for, and you're reaching the expiration date and you realize you don't want to sell it, those are the times when we can roll out and get what's called a credit spread by rolling out to a higher strike price at a future date and still bring in some money. Let's see. Oh, the profit loss is obviously the strike price, whatever your strike price is, minus the cost of your stock plus the premium collected. So if you buy a stock for 90, you write a call at 100, you get $1 for it, your profit is going to be $11 minus whatever fees or transaction costs there might be. But let's just say it's $11. It's the difference between $90 and 100 plus the premium collected, 101, let's say. $11 is your total profit, and that's something that can be repeated over and over again in IRAs without any real ramifications tax-wise. Let's see here. Okay, so if we go to the next slide, that first scenario is probably the most likely scenario that I utilize covered calls with. Meaning, I just bring in premium, it enhances return. You get a stock that, let's say, yields you 3% on the dividend, and we can boost that dividend from 3% to 9% over the course of a year simply by writing pretty conservative covered calls. Or perhaps for other stocks that don't have a dividend, we can create what we consider an artificial yield. So a stock like an Amazon that doesn't have any dividend to pay out to its clients or to its owners, we write weekly or monthly calls on it, and that is money that comes in just like a dividend would, only instead of waiting 90 days for that dividend to come in, you can bring that dividend in or that artificial yield in every week, every 2 weeks, every 3 weeks. You can ladder it. There are various ways to do that, but it's a great way to bring in money. Okay. The second reason why some of my clients will utilize covered calls is because it can offset a declining market. So I think it was Michael who had mentioned, he's up 2%. And part of the reason is the premiums that I'm sure that his fund takes in for the underlying positions that the funds are utilizing. And that's similar to what you can do with covered call writing. You offset the downside by the amount of premium that you bring in for each position that you utilize. Chris, how am I doing on time? Do I have enough time to continue?
Yep, you are good.
Okay.
Yeah.
So like it says here on the bottom here, if a stock's been beaten down and the trader thinks there's a rally in order, they might decide to forego the covered call because you might want to capture that upside. But sometimes, like for instance, we were down from the beginning of January through the end of June. I think it was like the worst market open first 6 months of the year since 1923. I forget what the actual downside was in the S&P, but the clients, my clients that were writing covered calls the entire way, sure, their positions continue to go down. There's not much you can do about the downside effect of the actual position. However, that downside was mitigated by all the premium they brought in week after week after week. So if I can bring you 15% premium over the course of 6 months, well, that mitigates 15% downside protection in your portfolio. And many of my clients will do that. And sometimes you want to get more aggressive. What I try to encourage my clients to do is wait for what I like to call bear market rallies. Every bear market has them. And so, people will jump out of the market because they start to panic. And then all of a sudden the market goes up because the pricing gets somewhat decent. And so they realize, oh my gosh, I just missed out. Well, I tell my clients to just sit on their hands, wait a second, there's no reason to panic. Let's wait for this next rally to come. And once we see that rally start to take hold, we start writing covered calls. And the reason we do that is because we're confident that at some point in the near future, when that bear market rally starts to decline, the strike prices that we set will be far above the actual stock price. And so we'll get to keep the entire premium and wait for that next bear market rally to come and do it all over again. And so I think there's been at least 4 bear market rallies since the beginning of the year. This last one that began at the beginning of July has been absolutely wonderful. And we've written a lot of covered calls as a result. So the next question is, when is a good time to act? Honestly, that's up to my client, you, and myself discussing, your objectives. And are you married to any of your positions? And do you mind paying, a certain amount of tax for the premium that comes in taxable accounts? So the time to act is when you feel like you're ready to either provide yourself, and I'm speaking only relative to covered calls right now, not a speculative strategy, not a straddle or a strangle or any of those. I'm talking about a simple covered call. When is it time to act for a covered call? That depends on the client, but really any time is a good time, provided you are okay with the strike price you set, the amount of money you receive, and the timeline that you set at the beginning of the contract. So if you choose a strike price that is 10% higher than the stock's present value, and you're comfortable with letting your stock go at that price, it's time to write the covered call. Many times, especially for my beginner covered call writers, let's call them, they'll say to me, yeah, Peter, I'm comfortable with a 10% gain. So why don't we write the call, the strike price 10% higher. And then we get to expiration date and the stock is 12% higher, which means they're going to be called away from their stock, and they get remorseful and they don't want to get called away. And so, yes, there's ways to get out of it and still make money, but it's been my experience in the 24 years that I've been doing this, that what my client might say the first time they write a covered call may be drastically different than when the actual exercise or assignment comes and they realize, oh no, I'm actually going to lose this position. Sure, I'm going to lose it at a 10% greater value than it was when we wrote the call, but I feel like there's more upside potential and I'd like to capture it. Again, don't fret, we can cover that, but that for me is one of the most telling signs of how I can assess my client's, let's call it risk tolerance and investment objective. Because when a client says to me, I'm willing to sell it at 10% higher, and the stock gets 10% higher and they let it go and they say, okay, what do we do next? Then I know they are certain about that 10%. Whereas when another client says the same thing and now they're starting to have, trepidation about letting go of their stock, I know the next time that I speak with that client about the next covered call, we're going to have a little bit different a discussion, because I can see that they may say one thing, but they really feel something else. And sometimes it's about me talking them off the ledge, and other times it's about me letting them know it's probably a good idea to let go of the stock, because chances are we're going to be able to buy it back at a much lower price sometime in the near future. And that happens a lot, especially in bear markets with bear market rallies. Okay, last but not least, what happens when you get called away? I pretty much already explained that. First, if the stock goes above the strike price, you're going to get called away, netting the overall profit to the strike price versus the purchase price and the premium received. Again, when I do covered call writing with most of my clients, we use a certain delta, which is the probability of you getting called away. And we usually come in at around 20%, so that when we write that covered call, we set a delta of 20. And what that means is that there's an 80% chance that the contract will expire worthless and they'll keep the entire premium without having to worry about a roll. There's a 20% chance that they may get called away. For the more conservative clients, we use a 10% delta. And for the more aggressive clients, we'll go up as high as 50%. I don't have too many clients that will actually go 100% or 80%, let's say, right at the money calls. Most of my clients like to ride the stock a little bit higher than that. But the point being is we have to determine what you're comfortable with when writing a covered call. If you're comfortable, let's say inside of an IRA, going in and out and in and out and in and out of a stock time and time and time again, because again, there's no tax ramifications, there's just work to be done, then that's wonderful. I don't mind doing that work for you. But if you're going to not be certain, then I'd rather have a client that has certainty about an outcome, regardless of what it is, than one that might feel like they want to change their mind. It's better for your confidence, it's better for me managing your portfolio, and it's better overall because we spend more time utilizing the strategy that works best for you rather than making changes and sort of changing things around when we first talked about what we expected. And now that it's time for that to actually come to fruition, I don't feel the same as I did when we first talked about it. So it's about sort of narrowing down what the strategy is going to be for each client. So a couple of things you might want to notice here is a covered call has some limits for equity investors because the profits from the stock, again, even though we can change it, they can be capped. So as an example, recently I wrote many of my clients Amazon stock at around a 135, a 136, a 137 strike price, and they got called away. And Amazon was trading at around 140. So they lost $3 to the upside. However, I can say that because we've been writing covered calls for those same clients throughout the last 6 months, 7 months, they've made much more than $3 in premium on their way up to 136. So I would say the average client has probably made somewhere close to $15 on that, which means they're really selling the stock closer to 151 if you take their premium involved than 136. All right, so now they really didn't lose that $3 upside. They just made it up along the way. And I think the last thing that you want to worry about is, or be concerned about is, again, there's a lot of work to be done. That's why you hire somebody to do that work for you. But there is the risk of losing certain positions. And I want to make sure that that's clear to most people because, you figure in a bear market, oh, the chances of getting called away are pretty low, but it can happen. And so I implore you to think about the positions that you're considering writing covered calls with. Because if there are positions that you are married to, even though we can roll out and get credit spreads, sometimes you can get called away before the expiration date, especially if a stock has a dividend sometime prior to the expiration date. Many times, I would say 90% of the time, if a stock is in the money, it will not get called away until the expiration date. However, there is a caveat to that. If the stock has a dividend coming due, let's say 2-3 days or even 2 weeks before the expiration date, I would say that number goes down to about 50%. A lot of times the other side of the contract will say, well, you know what, I can capture the stock at the price today and get the dividend. I think I'll do it. And so you might get called away. So these are things that you might want to consider when you're writing a call on a stock that you might be married to, or you might have sentiment towards. It's something that is a client's own personal taste and choice. Most of my clients, I've had them for a very long time, and we already know which stocks we are ready to let go of and which stocks we are not. As an example, I've got a client I've had for about 22 years. They live in Torrance, and they used to work at Chevron, and so they've got a lot of Chevron shares. The whole family does. And I would say half the family could not care less about letting go of Chevron, and the other half won't let go of it to save their life. So, it's a matter of preference. For those that don't care about the Chevron getting called away, we've been writing covered calls till the cows come home, and they've been extending that yield and raising the yield on that stock for literally 2 decades. And for the other ones, we're just much more conservative. So we go to maybe a 5% delta, whereas the other ones are much higher than that. But they still do utilize the covered call writing strategy. They just don't do it as aggressively. They do it almost so conservatively that, if Chevron's yielding 3%, 3.5%, annualized, maybe I'm getting them 4.5% with the covered call rights. Whereas the more aggressive ones, they're bringing that 3.5% up to about 10%. And that's what we can do for you. And I think that's all I've got, Chris.
Excellent, Peter. Thank you so much. I want to thank everybody again. Man, we had a really good turnout for this webinar. There were a lot of people tuned in. I'm not sure whether or not you guys knew you guys were going to school, and I hope you were taking notes. And it's a lot of information that came out of the two of us. Here's my takeaway, and what I want you guys to leave here with is to understand that managing money and handling client assets has way more going on behind the scenes than just slapping some stocks and some mutual funds into a portfolio and hoping that it does well. We spend a lot of time here looking to not only capture and make sure that your accounts are growing, but a lot of time managing risk and adjusting portfolios and looking at the underlying factors to try and put you in a position of success regardless of market environment. And so, as you can see, there's a lot that goes into options trading, as Peter discussed, and there's a lot that goes into the creation of our models that are more than just picking some good mutual funds or picking some good stocks. So aside from that, I was trying to polish my crystal ball here while Peter was talking and really get an outlook for the future to close out with. And again, my crystal ball doesn't work very good and never has. So it's really tough to say where it's going. If you're friends with me on Facebook, you probably heard me say that I do believe that with 2 consecutive quarters of negative GDP, it feels like we are in a recession. It feels like things have slowed down. I've also said that some of the silver linings out there make me believe that it might not be as bad as some are alluding to that it might be. It definitely doesn't feel like a 2008 type situation. Obviously, we will have to wait and see, but it feels mild in my opinion, but it does feel soft. And so that is why we have taken some defensive approaches this year and put positions in place to try and weather the storm of what the market is throwing at us. But at the end of the day, like any market, I do believe we will be fine and we will work our way out of it over time. And long term, we will do phenomenal by being invested and staying invested for the long haul. So I have no doubt that in the long run, we will be great. And so more than anything, as things continue to be volatile and a little nerve-wracking over the remainder of this year, stay calm, understand, and look at the longer term versus getting caught up in the day-to-day of what's going on. And just know that we are actively doing things like we discussed tonight to help weather the storm and position you for success. So obviously, we are here for you. So please call us. Let us know if you have any questions. If you want to meet with myself or Peter, please reach out. We're happy to expand on some of the things we discussed tonight. We are here for you. So let us know what we can do to help out. And we look forward to seeing you on the next quarterly webinar in 3 months from now. So have a great night. Again, thank you so much for joining us. We really appreciate your time.